Topic explains that Basel I was the first internationally coordinated banking regulation framework developed by the Basel Committee on Banking Supervision in 1988. Its primary objective was to strengthen the stability of the global banking system by establishing minimum capital requirements for internationally active banks. Basel I introduced a standardized approach for measuring credit risk and required banks to maintain minimum capital equal to at least 8% of their risk-weighted assets. Assets were grouped into broad risk categories with assigned risk weights based on perceived credit risk levels. The framework aimed to improve consistency across international banking systems while reducing competitive inequalities between financial institutions operating globally. Basel I classified bank capital into two major categories: Tier 1 capital and Tier 2 capital. Tier 1 capital represented core capital elements such as common equity and retained earnings, which provide the strongest protection against unexpected losses. Tier 2 capital included supplementary items such as subordinated debt and loan loss reserves. Regulators required a significant portion of minimum capital requirements to consist of Tier 1 capital due to its higher loss-absorbing quality. Although Basel I improved international banking supervision significantly, its relatively simple risk-weighting system failed to capture differences in borrower credit quality and portfolio diversification accurately, creating incentives for regulatory capital arbitrage. As financial markets evolved, regulators recognized important weaknesses within Basel I, leading to several revisions and amendments. One significant development was the 1996 Market Risk Amendment, which introduced capital requirements for trading activities and market risk exposures. Banks were permitted to use internal value at risk (VaR) models, subject to regulatory approval, to estimate market risk capital requirements. This represented a major shift toward risk-sensitive regulation and greater reliance on quantitative modeling. Despite these revisions, Basel I continued to face criticism because its simplified structure did not adequately reflect modern banking complexities, operational risks, securitization exposures, or rapidly growing derivatives markets. Topic also focuses on Basel II, which was introduced to address limitations of Basel I and create a more comprehensive and risk-sensitive regulatory framework. Basel II was built around three mutually reinforcing pillars: minimum capital requirements, supervisory review, and market discipline. Pillar 1 expanded risk measurement by incorporating credit risk, market risk, and operational risk into capital calculations. Banks could choose between standardized approaches and advanced internal rating-based methods depending on institutional sophistication and regulatory approval. This framework aimed to align regulatory capital more closely with actual economic risk exposures while encouraging institutions to improve internal risk management systems and governance practices. Pillar 2 of Basel II emphasized the supervisory review process and the importance of internal capital adequacy assessments. Regulators expected banks to evaluate their own risk profiles comprehensively and maintain sufficient capital beyond minimum regulatory requirements when necessary. Supervisors reviewed governance structures, stress testing frameworks, risk management practices, and internal controls to ensure institutions remain financially resilient. Pillar 3 introduced market discipline through enhanced disclosure requirements designed to improve transparency and allow investors, counterparties, and stakeholders to assess institutional risk profiles more effectively. Together, the three pillars sought to strengthen banking stability by integrating quantitative capital standards with governance, supervision, and market accountability mechanisms. Although Basel II represented a major advancement in global banking regulation, the framework also revealed weaknesses during the global financial crisis of 2007 to 2009. Complex internal models sometimes underestimated risk exposures, while excessive reliance on credit ratings and historical data weakened resilience during stressed market conditions. Some institutions maintained insufficient capital and liquidity despite appearing compliant with regulatory standards. These weaknesses led to further reforms under Basel III, which strengthened capital quality, introduced liquidity standards, and emphasized stress testing and systemic resilience. Nevertheless, Basel II significantly influenced modern risk management practices by promoting integrated risk measurement, operational risk recognition, enhanced supervision, and greater transparency across international banking systems.